Biden is raising the cost of home ownership on those with good credit. Is that true? I've been getting a lot of incoming text, emails, people giving me a call, inquiring what's going on. Is this can't be true, right? Here's the scoop. On May 1st, loans that are purchased on or after, there's a change with the loan level pricing adjustments. And whether it be on newspapers, online, TV, there's all this information out there, and people are seeing the headings, and it's deceptive. So people don't know what is true. So I figured I'd take this opportunity to navigate through the chaos and explain to you what the actual change is. Let's take a look. Okay, so doing a Google search, I just put in home buyers with good credit. First thing that pops up, Biden raises costs for home buyers with good credit. A new federal rule could raise monthly mortgage payments of buyers with good credit. For here, high credit scores will mean higher mortgage rates for home buyers under new blah, blah, blah. Mortgages for home buyers with good credit to cost more starting May 1st. And, here's all these different videos. How the U.S. is subsidizing high-risk home buyers with good credit to pay higher mortgage rates. You jump on Twitter here. High credit scores, tough luck. Biden administration punishes Americans with good credit. Biden rule will redistribute high-risk loan costs to home buyers with good credit. And it goes on and on. So, there's a lot of information out here. And you read the headlines. What is all this? First off, this is the old matrix, loan level price adjustment matrix. This is for loans that were purchased on or before May 1st. And here we go. It's basically a grid. Let's get that in there better. So all eligible loans, LLPA by credit and score. So this is for example, like any loan that's greater than 15 years, a 20-year, 25, whatever the case. And this came out years and years ago. They initially called it like risk-based pricing. The pricing on a loan was based on the risk. And on this side, you have credit score going from 740 on the top end all the way down to 620. And then in terms of loan to value, 60% loan to value on the low end, 95% on the high end. So low risk, which is high credit, low loan to value, zero adjustments, or on the opposite side, high loan to value, low credit score, big adjustments. So if we take a look here at this 80% loan to value, 740 credit score, you have a 0.500. This is in basis points. Now, this is not interest rate. Basis points equate to 50 basis points here would essentially be on every $100,000 of loan. It would equate to either $500 in cost, or you would simply go to a little bit higher interest rate. 50 basis points might be a quarter higher in interest rate. To take care of this basis point adjustment, this loan level pricing adjustment. So 740 score, 0.50, then we drop down to 70.75, 1.25, 1.75. So it's making sense. It's getting more and more expensive as the score is going down. Same thing in terms of from a loan to value. Here there's none. Here it jumps up to 75. It's always been a little quirky in this 80 bucket because by putting 20% down payment, you were getting slightly worse terms than if you were putting less down and incurring mortgage insurance. So it was always kind of a little whacked out in this 20% bucket, but let's see what the change is. Okay, so this is for loans purchased on or after May 1st. And we got the same grid here, except there's a couple extra buckets in terms of credit score. Now we have a 760, 780 on the high end. And then on the low end, we have a 30% bucket. Still same risk-based pricing, but they made some changes where people aren't getting hit as much on the low end, and that's causing all those articles. But what the articles are not mentioning is those with good credit are not getting hit as much on the high end. So let's take a look at this on a graph, which this makes it a heck of a lot easier to see. So here's the difference between new and old. Red and orange is bad. Yellow and green is good. So credit score lower end, lots of positive effects, and this is where people are getting, all bent out of shape. Here on the higher end of credit, it's worse. In this bucket, the worst case scenario is 75 basis points worse. This 740, 720 range with 15% down payment. But here's the thing, nobody's mentioning people with good credit with low down payments or little equity at 95% loan to value or greater. Well, we have positive adjustments. Nobody's mentioning that. The other big one, this is huge, income base. So if we go back to our grid, keep scrolling down, loan level pricing adjustment waivers. All loan level pricing adjustments will be waived for the following loans. Home Ready, which that's Fannie Mae. Freddie Mac has Home Possible, which is available if you're doing a refinance as well or purchase. Loans to first-time home buyers with qualifying income equal to or less than 100% area median income. What does that mean? So how you figure the area median income, I like to go to Freddie Mac's website. So if you were to do a Google search, Home Possible Income and Property limits, this website will come up, a map. You simply put in the address and this box will pop up, and here it's saying, okay, this is Cook County and the 100% median income is 105,700. If your income is less than this number, all those adjustments here are completely gone. If your income is 80% or if it's 50% of the median income, then there's a couple different programs, Home Ready, Home Possible. There's some other programs available where, they give down payment assistance money, or there's all these different programs out there. The main thing to take from this is if you have good credit and your income is less than 100%, you are going to be getting much, much more favorable terms than previously available. That's what they're not discussing. So hopefully by walking you through the actual change, you can see not all people with good credit are being taken to the woodshed. Yes, unfortunately, some are paying a little bit more, but there's a lot of people with good credit that are going to be paying less. Whole thing is income. Income is the huge one. Also loan to value, but income. So if your income is less than that area median income, you're going to be receiving much better terms. And key thing is, it's my job to help navigate through all the different programs and rules out there to maximize your situation. So for example, let's say two individuals are buying the house, but you only qualify with one income. Maybe we go that route where your income is under the median so that you do not have those pricing adjustments, so you get much, much better terms. So that's what I'm here for. Hope this helps clear up some of the confusion. If you have any questions, give me a call, shoot me a text, send me an email. Thank you very much.